Hey, what's going on, everybody? It is Thursday, October 28th. New high in the Dow and the S&P, and NASDAQ is heading up there. We're getting close to a new high. If it wasn't, I don't know, maybe it was a new high. I didn't really track, but we had a good day in all the market averages, and that's kind of like what I've been telling you was going to happen. We got the Advance third quarter GDP that came out today, up 2%. So that was better than what some of the forecasts, like the Atlanta Fed had the forecast at 0.3%. So 2%. I think the consensus estimates were around 3.5% to 4%. So we came in under the consensus estimates, but better than the Atlanta's Fed GDP now. One thing to note was that final sales of domestic product was actually negative. It was negative, I think it was 0.1%. What are final sales? That's everything in that GDP calculation that gets, that gets sold. And that's really an important measure of GDP. The reason why overall GDP was up and not negative, because final sales, again, were negative, is when you factor in inventories. If you have an inventory build, then it would lift it up, and that's exactly what we saw. But hey, we need more inventories, right? This whole pandemic, what the pandemic has exposed is the fragility of this just-in-time inventory model that so many businesses use now. And we've really seen this thing exposed as to its weaknesses when you have something like the pandemic. What happened? The shelves went empty because companies tend not to keep large amounts of inventories on hand. They see that as a loss. They try to work this as a just-in-time process. In other words, when the orders come in, there's going to be fulfillment. That's when you get some inventory to directly satisfy the orders. I mean, in the old days, and I'm talking going way back, like in the 60s and the 70s, before we had this just-in-time inventory management, companies and manufacturers would keep inventories on shelves. So back then, the likelihood of something like what we're experiencing right now with these shortages due to the supply chain bottlenecks and all that stuff, that may not have happened, or at least not to the degree that we have seen it happen recently. Anyway, that was your GDP report. It wasn't as bad as some of the shadow, or I should say whisper forecasts. Earnings keep coming in very strong, and I said that was going to happen. It's powering the market higher. Some of you mentioned the fact that the Treasury is already up against the debt ceiling. That's the new debt ceiling that was increased, early October, where they raised it $485 billion. That's true because Treasury has boosted its account at the Fed up to, I think it's around $260 billion from literally it was practically nothing just before they got that go-ahead to resume debt sales. So now that account is relatively flush. I mean, it's not at high levels, but what you're going to see now is the Treasury start to spend out those funds in meeting payments. So I mean, it has the money now to carry through the month of November into the next deadline, which I said is around December 3rd. So we're okay, even though the debt ceiling is once again at the limit, and it didn't take very long, but that was expected because Treasury had to replenish the funds in that account, so they did it quickly with debt sales, and that's why we went back up to the new limit. But now it's got the money to spend through the remainder of this month and into, I guess, most of November or all of November, leading up to that December 3rd target date once again when we're going to be back into all these shenanigans. Yesterday's fiscal flow was a pretty decent flow. We got about a 41 billion flow yesterday. That included a 21 billion Social Security payment. So if you subtract out the Social Security payment, it was still around 20 billion. That's not bad. The month of October so far, and that's through October 27th, we are at 481 billion for the month. We're going to go over 500. You got 2 more statement days left in the month. You got, today, which we'll see on tomorrow's Treasury statement, and then Friday. So we're going to be up around 510, maybe slightly over 510 billion. You know, that's decent. Now, that's down again for, let's see, March, April, May, June, July, August, September, October. So that would be the 7th month of decline. But here's the good news. I think we're stabilizing now at around this number, which is about 500 billion a month. That would be roughly about 25% higher than the pre-pandemic monthly fiscal flows. All right, so that's not so bad, about 25% higher. And don't forget, the government is still running without a budget. Congress has to come together and pass a budget. We are on a continuing resolution which only funds the government through December 3rd. Now, they have to come up with a budget. Otherwise, it's another government shutdown. But the Constitution mandates that they have to come up with a budget. So they're going to have to come up with a budget at some point. And I would suspect when they do come up with that budget, it's going to contain higher levels of spending. So I think we're okay. This is not the March 2021, almost $1 trillion in 1 month, but this is a good, solid, stable flow rate, or it should be a stable flow rate of slightly above 500 billion a month. That's 25% more than pre-pandemic. In the pre-pandemic period for years, and I'm not just talking about a month before the pandemic or 2 months. I'm talking about going all the way back to like when Trump was inaugurated. That was enough to really push the market higher. It was enough to keep us around 2 to 3% economic growth. You had corrections, market corrections within that environment. But that's no big deal. That's a good opportunity whenever those things happen to add on to good high quality stocks. As I always say, like get your list of your favorite stocks, your high quality stocks. And when we have that pullback. Fed, somebody asked me today, Mike, how is the Fed going to taper? Come on, when there's a 2% growth rate and when there's negative, final real sales. I don't know. It's the Fed. It is influenced by the media. It is influenced by politicians. It is influenced by market pundits. It is influenced by regular people complaining about things. So they're still fixated on, the inflation, even though I saw something, somebody sent me a thing yesterday, again, from that blog, Zero Hedge, that now, oh my God, the bond market is predicting a recession. First, the bond market was predicting inflation. Then it was, according to these people anyway, first the bond market was predicting inflation. Then it was predicting hyperinflation. Then it was predicting stagflation. Now what? It's just predicting stag and not deflation. This is what you get for following these things. I told you that prices were going to moderate. Economic growth was going to slow down, and that itself was going to cause prices to moderate. And that's basically what we're seeing. So bonds look good. We had a big rally in the bond market yesterday, gave a little bit, tiny bit back today. But I suspect with that huge short position in the futures markets and bonds, and I've been talking about that, mainly driven by small speculators. Banks have been buying cash treasuries. I mean, you can have the mother of all short sales, particularly when you consider that this fiscal year, we're going to see a pretty significant decrease in total issuance of treasuries. So the supply is just not going to be there. You know, institutions need to own treasuries as part of their asset mix. You could see that every month with the banks buying. You got small speculators short out the wazoo. I mean, this is shaping up to be a really, really incredible, I think, rally, short covering rally that could carry for quite some time. Anyway, that's it for today, folks. Don't forget, check out my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader, and I will see you tomorrow.